What if I told you the world's most legendary investor is rethinking his approach in 2025? Yep, Warren Buffett, the Oracle of Omaha, is making moves that might just surprise you. So what's his game plan? And more importantly, how can you use his wisdom to thrive in today's market? Stick around. By the end of this video, you'll know exactly how to navigate these unpredictable waters, Buffett style. The investing world is a bit of a roller coaster right now. Interest rates are high, stock valuations are eye-watering, and speculation is running rampant. So what does Warren Buffett, a man who's seen it all, suggest we do? In today's video, we'll break down Buffett's advice for navigating the 2025 market, including why he's ditching some stocks for treasury bonds, what he thinks about those magnificent 7 tech giants, and his timeless strategies for patient investing. By the end, you'll have a playbook straight from the Oracle himself. Let's dive in. Why Buffett is eyeing treasury bonds. With rates holding steady at around 4.2% after a few cuts, short-term treasury bonds are yielding a solid 4.3%. That's right, low risk and decent returns. It's no wonder Buffett is shifting billions into treasuries. Now, why should you care? Because this move highlights one of Buffett's golden rules: protect your downside. Stocks might be tempting, but when safer investments offer attractive yields, it's worth reconsidering where your money goes. Visual cue: show a chart comparing treasury bond yields to S&P 500 returns over the last year. Buffett isn't abandoning stocks altogether. He's just waiting for the right opportunities. More on that in a bit. Let's address the elephant in the room: the Magnificent Seven. You know them: Amazon, Apple, Microsoft, Tesla, Google, Meta, and Nvidia. These companies have dominated the market, but Buffett thinks their valuations are, frankly, sky high. In fact, he's even trimming Berkshire Hathaway's massive Apple stake. Why? Because Buffett's philosophy is simple. No matter how great a company is, overpaying is a recipe for mediocre returns. Imagine paying $10 for a $5 sandwich just because everyone says it's the best sandwich in town. That's what Buffett sees happening with some of these tech giants. And here's a pro tip from the Oracle himself: don't fall in love with a stock. Always focus on value over hype. Buffett isn't just sitting on cash or treasuries. He's been looking beyond the US market for value. Case in point, his investment in 5 Japanese trading houses. Back in 2020, Buffett called these stocks ridiculously cheap. And since then, they've delivered strong returns. What does this mean for you? Sometimes the best opportunities lie where others aren't looking. Buffett has been vocal about the casino-like behavior in today's markets. Meme stocks, speculative crypto bets, and day trading frenzies are running wild. But as Buffett says, the stock market is a device for transferring money from the impatient to the patient. This speculation can actually create opportunities for those who wait. When bubbles burst, prices fall, and that's when the patient investor strikes. And speaking of patience, Buffett's approach to waiting for the right opportunities is a masterclass in discipline. We'll dive into that next. One of Buffett's most famous analogies is the 20 punch card rule. Imagine you're only allowed to make 20 investments in your entire life. What would that do? It would force you to think carefully, choose wisely, and focus on quality over quantity. Buffett believes this mindset is crucial, especially in today's overvalued market. Instead of chasing every hot stock, focus on businesses with strong fundamentals, durable competitive advantages, and reasonable prices. If picking individual stocks feels overwhelming, Buffett has another tip: index funds. Broad market diversification combined with dollar cost averaging is a strategy he's recommended for years, and it's especially relevant now. Now, let's shift gears and talk about how high interest rates are affecting businesses. Borrowing costs are up, debt servicing is more expensive, and companies with weak balance sheets are feeling the heat. For investors, this means 2 things. Be cautious with companies carrying a lot of debt. Look for businesses with strong cash flow and minimal reliance on borrowing. Buffett's track record shows that he prioritizes financial stability, and that's a lesson we can all take to heart. Visual cue: show a list of industries that are thriving versus those struggling in a high-interest rate environment. Despite the challenges, the S&P 500 has been on fire, rising 23% in 2024 and 24% in 2023. But Buffett remains cautious. He knows that strong past performance doesn't guarantee future results, especially when valuations are stretched. His advice? Don't get caught up in FOMO. Instead, stay disciplined and stick to your investment plan. Remember, the goal isn't to beat the market every year, it's to build wealth steadily over time. What do you think of Buffett's strategy? Are you rethinking your investment approach for 2025? Let me know in the comments. I'd love to hear your take. And hey, if you're enjoying this breakdown, don't forget to hit that like button. It really helps the channel grow and brings more content like this your way. So what can we learn from Warren Buffett in 2025? Be patient, focus on value, and let the market serve you, not the other way around. Whether it's shifting into treasury bonds, waiting for stock valuations to improve, or looking globally for opportunities, Buffett's strategies are a masterclass in disciplined investing. And remember, you don't have to predict the market to succeed. As Buffett says, the best way to make money in the stock market is to be consistently not stupid. If you found this video helpful, subscribe for more investing insights inspired by legends like Warren Buffett. And if you want to dive deeper, check out our video on how to spot undervalued stocks. It's packed with actionable tips you can use right away. Thanks for watching, and here's to making smarter investments in 2025.